Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good afternoon, everybody. It is time for the Federal Reserve press conference. We got about 4 minutes coming on here. Yeah, not really much has changed in the markets. To just show you real quick here, ZN is just kind of flat. S&P 500 moved down a little bit, came back. Really nothing too interesting to speak of. Does seem to me like my read earlier was correct, that we got flows going both ways a little bit of a fight in here, and I was looking for something a little bit bigger than that, but so I totally played it correctly and it just kind of didn't get the lucky exits on those earlier trades. Now here for the Federal Reserve meeting, I'm anticipating that this is going to be really crazy volatile. So I'm going to be very, very hesitant to really take a trade unless I really see something that makes me think this is going to go all day. Like, it's got to be something that's like, oh, this is going to turn today into a trend day, or maybe I have a contrarian play. But especially for the press conference, man, I think the market is going to be way overly sensitive to what's going on here. So that can make for some illogical moves, you know what I mean? And I hate that kind of stuff. So we'll be a little bit on the cautious side here for that. Jimmy Oreo just think it 22 minutes from now we are going into an easing cycle, if you say so. I'm not convinced that we're going to be easing later in the year. I'll put it that way. I think that we should have a pause. It's kind of funny because I'm not convinced that we're going to have rate cuts later in the year, but I also think we're going to have a hard landing. So Well, we are 3 minutes out and the liquidity has completely disappeared. It's going to get even worse here in about 5 seconds here. Watch. I guarantee you, right there, a minute away. Yeah, a couple are gonna pull there. 14. It's not as bad as it has been in other times. Scott, haven't you asked me about market profile before? We talked about that yesterday. I will talk about it again. Now's not the time to ask though. No? Oh, okay. Well, I've got a video coming out on it, so it's funny that you guys keep asking me about it while I'm developing a video about it. Yeah, no, it's okay. We'll do it after, all of the Fed stuff is done. I'll remind me. All right, here we go. 10 seconds. Okay, 25 basis point hike. They did drop the comment that they will, okay, so I'm just gonna pull this out here. Jeez. That's pretty aggressive movement. Okay, so they removed the okay, so it used to say the committee anticipates that Some additional policy firming may be appropriate in order to attain the stance of monetary policy that is sufficiently restrictive to return to 2% over time. And then in determining the extent of future increases in the target range, they'll take into account cumulative policy, monetary policy, etc., etc. They have removed that. In determining the extent to which additional policy firming may be appropriate to return to 2% over time, the committee will take into account the cumulative tightening of the money. Okay, so they're saying that we're happy with the interest rate that we have, and that will continue to be data dependent is basically what we've seen. There was a comment earlier. Recent developments are likely to result in tighter credit conditions for households and businesses. Now it says tighter conditions for households and businesses are likely to weigh on economic activity. So that one is actually a little bit more dovish than I expected. Yeah, I would say overall that the statement is the market is reacting with I would say reasonably to what we're getting here today. So I think we can play this with sim orders. I mean, it was a big jump up, of course, but you expect that on the Federal Reserve. I'd say there's a reasonable move. It hasn't been like the last ones where like they didn't change anything important. What are you doing? Just messing around. Just messing around. It would have been nice to have gotten 116. It came awfully close to coming back to it, but didn't quite get there. Cool. I'm not sure I would call this an as she goes trade, to be honest with you. I'm just taking it where it's at. Oh, hey, that wasn't too bad. Why did the dollar drop if they raised the interest rate? Okay, good question. So what this, okay. So you have to consider what the market expectation is compared to what they got. So the market was expecting that the Federal Reserve would raise the interest rate, right? But the market did not expect that they were going to strike some of this language about, continuing to raise rates to make a policy that's sufficiently restrictive, right? Policy statement seems to be suggesting that they think that it's restrictive enough, and they're also, continuing to put a statement in there about, some of the recent economic volatility, and that's likely to that's likely to make conditions worse, and so they don't necessarily have to be super aggressive. Anyways, okay, the market didn't expect that, so that was more, the statement was more dovish than the market expected. Okay, and so that is why treasuries are buying, and you saw equities buy as well, although equities have given up most of those gains so far. Okay, so if a monetary policy is going to be easier, you're not going to get as high of an interest rate through the United States, and that causes the dollar to fall. Dollar falls, Japanese yen moves up. Did it really give me both of those, really? And then right back up? I don't know, guys. That worked a little bit too easily. You think I've gotten into an overreaction? Well, I'm mostly trying to just catch the range here. I wouldn't call it an overreaction though. I'd say the volatility that we got's pretty in line with what the statement was. I do feel I used a little bit too much risk to build this out. I don't think we're getting up to there. Yeah, the volatility was, I have to say that worked a little bit too well, to be honest with you. But I feel that 1/6, you know, I think that we should stay above 116. Kind of the area I'm kind of watching. That was kind of the area from before the news. Now they're probably going to try and test us on the other side. At least it's starting to look like they may test us on the other side. I'm not a huge fan of that one. I want my break-even point to be below 116. Nick Dimmeros, the FOMC statement used language broadly similar to how officials concluded their interest rate increases in 2006, with no explicit promise of a pause by retaining a bias to tighten. Was the same as usual? I would say it was roughly was, so yeah. Yeah, that's not incorrect. The liquidity is awfully light still. And a bunch of new squawks pointing out what Nick just said there. I think that's a really interesting comment. I don't know if it's that important, but it's a really interesting comment from him. Let's see here. Here's what Nick had to say about the decision. The Fed raises rates by 25 basis points as expected. The policy statement softens the rate guidance in a way consistent with past pauses, deletes reference to some additional policy firming may be appropriate, and the decision was unanimous. Okay, so thinking about this, like, so one of the first things is like, where do I take it? Sometimes you have like a good spot given the liquidity positions to take something. What makes this kind of action difficult is that you don't often have those. Although there is a little node developing there right at 29.5, big iceberg holding it back. But, you know, when the liquidity is really light and it's moving around so much, you know, sometimes you just have to take it where you're going to get it. So then the question is, are we going to see more buys or more sells over the next 2 hours, right? Well, I think that I am leaning towards more buys, and that's why I started to play with this, but I didn't take it on a live trade. Because the statement was more dovish than anticipated, and I'm going to bet that Powell also strikes a relatively dovish tone in the press conference. Okay. The big risk, I think, to this one would be, there was some buying yesterday. I don't know how much of that was front running it, but you could see profit taking, right? Profit taking, selling. I'm sure that some of that is already going on. I mean, I have seen, on the day we got cumulative delta to negative 4,000. So, I think that says it's, that risk is still there. So you're holding through the conference? Yeah, I think probably for this kind of like swing, and again, I got to be like really, really clear here, because the way that we're talking about it, I don't want to like mislead anybody. This is a sim order experiment on, utilizing high risk to work out a position, right? So, this could end up being like a complete disaster. It's a pretty big position for me to have on relative to the amount of volatility that we're having. So for those of you that are new, just remember we have the press conferences starts at the bottom of the hour. That will be streamed live on YouTube and all of the news channels and all that. Okay. So one thing I am seeing is there was a very wide, it was a steepener initially, for sure. Steepener in the yield curve, but that quickly came back, and now we're starting to see a little bit of steepening creep back in. So we'll see if they're able to, if the 5-year continues to push up or not. So far, I would say, looking at the flows from the cumulative deltas, that the flow in the treasuries is still a little bit iffy, yeah? Yeah, you wouldn't hold on even in some. What makes you think that they're going to sell it so hard? So also, like I said, the only thing I can see that would really be driving selling in here would be profit taking, and maybe just like the counterintuitive move that you get sometimes on these Fed meetings. But you never know what he's going to say. Maybe he ends up being hawkish. So it's like a super risky, it's a super risky one, right? Come on, let's go. That was a decent uptick. There's that 116 area. Just because it's a big number, it kind of ends up becoming a line in the sand. They have struggled a little bit getting above it. I don't know. To Lucas, it was like, I wouldn't even hold it even than sim. I think that one thing that we should keep in mind about this one is like the logic that I'm using here to say that there's going to be more net buying overall is pretty simple, in a very complicated situation. So that just stresses how much risk there actually is in trading this at the moment. I have to say I'm not too happy with how it's behaving around this 116. It got above it for like a tick, and then it couldn't extend. Carol Quintilla, in what amounts to a dovish surprise, the Fed has decided to remove the following line from the statement. The committee anticipates that some additional policy firming may be appropriate. A strong signal that the federal funds rate has hit its cycle healing. I disagree with that one. I think that means that we think that the current interest rate is appropriate. That does not mean that that's the end of the cycle. Not that I've ever seen this, but there can be like a mid-cycle, you hold it for a little while, and then later on you have to increase it more, okay? That can happen. Chris Christie on Trump possibly skipping debates. Obviously, he's afraid. You know what? You know, now is maybe not the time to go into that one too much, but I think it would be extremely unlikely for Trump to actually skip debates, and it would hurt him a lot if he did. Okay, there looks like they're gonna test this bottom side here again. There's definitely, so it's now about since the immediate aftermath of the news, net 6K contracts selling. So I would think that it's got to be profit taking, right? That said, in this liquidity, 6,000 contracts net, I think they're doing okay. Can you do another video about trading desktops Ryzen versus Intel chips? Are you unsure whether you want a Ryzen or an Intel chip right now? I don't know if that particular thing really matters too much right now, to be honest with you. Same with the graphics card, unless you're gonna do machine learning. If you're gonna do machine learning, you probably want a 30 series NVIDIA card or higher. Yeah. I've kind of been avoiding, I mean, I would like to make some more videos about hardware because it did so well for the channel. I'm not sure that this exact moment is the best time to do it. I've been okay at being able to look at the hardware changes that are coming up and finding when is the key time when it will be the most useful to people. There's a couple of interesting things going on with the Ryzen processors right now in particular that in the future could matter to the traders because they've got a processor, these 3D processors that are a lot more efficient. And, you know, I don't know if that really matters to you too much, but in the long run, it might if you're doing a lot of number crunching and stuff like that, right? But that last video, I tried to make it general so that it would always apply, and it does still apply, right? And that's why it's like, well, the things that I didn't mention in it are usually not super important, like whether it's an AMD or a Intel processor, probably not super important right now. I would probably go with a AMD processor right now, but the difference is pretty minute for what we're doing. So at the moment, it looks like we've kind of moved back into just trading maybe slightly lower than the range that we had before the news. At the end of this, we should check FedWatch and see where we're at, because I would expect the chances of a rate hike in June to decline here. So I don't like this too much. I took too many contracts here at 116, I would like to be playing this range here between like 30 and 31. You know, that range seems to make a lot more sense to me. Let's see here. I was about to look something up and now I can't remember. Yeah, you really don't need too great of a graphics card for trading anymore. All right, as long as you have like a 16, you know, like a 1650 would probably be sufficient. Anything more than a 1650, you're fine. I guess the White House is speaking at the moment. Just pull this out over here and hide myself, or should we put it up here? Let's put it up here. Cover our chart. And I tell you what, the dollar just got crushed on this thing, man. Am I still? Oh, I'm not. Not giving me new data. Sometimes when we get this kind of like crazy markets, my my dollar, it's like the data, you can't handle the data. I don't know what causes it to hang, but NinjaTrader will hang on those multi-indicator ones. I'm gonna try and restart because I really want to see what's going on with the dollar. Gonna make me kill it. Do you know a workaround in NinjaTrader to display price in the right margin when your actual chart is in overlay mode? No. If you're in overlay, it doesn't. What does it do? I'm not quite sure. But like if you had it aligned left, then it wouldn't show the price on the right side. Oh, but you know what you could probably do, Dave, is I think that there is a price indicator. So you could probably add the price indicator to your chart and that would resolve it, and that would do it for you instead. Okay. We'll restart to see if it gives me the data. So I got about 4 minutes to the press conference. What? Why? The index is rallying. That's what I would expect. The dollar tanking, that's what I would expect. Should see the dollar go down, equities move up, and treasuries move up generally. Well, treasuries did move up initially. Now they're kind of like, you know, like activity is dying down, but it died down to a level slightly lower than what it was before. I don't see anything in that tells me something about future flows. Right. If anything, what I'm seeing right now is just there's profit taking in the treasuries, because there probably some of that buying yesterday was buying ahead of the Federal Reserve meeting. So you mean that the hike in FFR doesn't get transmitted to the curve, rather it does the opposite? I think that the hike was largely priced in. Which is to say, who comes in here and says, I didn't think they were going to raise interest rates today. Now that they raised interest rates, I want to sell my treasuries. Because they did the thing that everybody in the market was anticipating, with like an 88% chance of it happening. Right? Elizabeth Warren says Powell should be tightening Fed regulations. Is that what I just heard over this news squawk? Okay. I don't think she's saying that they should tighten monetary conditions, but man, a weird way to say that. And an odd timing. Well, okay, so when I say priced in, what I mean by priced in is the orders are already in there, right? Isn't to say that there's like some price that's accurate and we've already done it in. I'm saying that the flow's not there, right? My question is, how does that what just happened result in sell flows in the treasuries? Why would there be people out there that would say, oh, okay, I guess I need to sell now, right? That's what I'm looking for. Right, that's something that would predict the flows. What's going to predict that they're going to sell? Because if the Federal Reserve raising rates 25 basis points causes you to want to sell the Treasury today, why didn't you do it yesterday or the day before that? Or, you know, the whole other like 3 weeks we've had where the market has been pretty sure that they were going to raise rates in May. Well, okay, that might be true. Nothing predicts that they're going to sell, but just like nothing's going to predict that they're going to buy. But that's where I'm placing a little bit of a bet here, right? I think that the Federal Reserve statement was a little bit more dovish than the market anticipates, and I think that the press conference is going to be a little bit more dovish than the market anticipates, and I think that that's going to result in some buying flows at some point. Right? Oh, sorry. I'm not on here. I need to unmute him here.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient.
Gonna turn off the
We will
music.
continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people.
Well, it is moving a little bit here, but it doesn't seem to be actually doing it in response to anything he's saying.
And we remain strongly committed to bringing inflation back down to our 2% goal. Price stability
Is the market straight up anticipating a rate cut starting July?
stability. The economy doesn't
That's not
anyone.
accurate.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions.
Sorry, but that statement that you just said there, that is not accurate.
The FOMC raised its
The,
policy
the
interest rate by
Fed
1/4
watch
percentage
tool is right now says that the market thinks that they're going to hold
by a
rates.
total of 5 percentage points in order to attain a stance of monetary policy that
Sorry,
is
let's come back and look at it.
to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic development.
Well, you said July, not June.
The U.S.
okay.
economy slowed
But
significantly.
even with July, the market says 51.3% chance that they keep the rate flat.
The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year,
What was the answer? Good
averaged
question.
345,000 jobs per month. The
Compare.
unemployment rate remained very low in March at 3.5%.
It looks like it was a little bit higher yesterday.
Signs that supply and demand in the labor
Yesterday was
market are coming
56
back
and now
into
it's
better
51.
balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years.
I don't know what time that was taken. That would depend on whether that was taken at the beginning or the end of the day, wouldn't it?
So far this year. But overall, labor demand still substantially exceeds the supply of available workers.
Okay, so you just said something about workers that was a hawkish comment, right?
Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy,
You're right, it does use ZQ.
our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food.
Okay, market S&P 500 does not like his comments about inflation here.
Poses to both sides of our mandate, and we are strongly committed to returning inflation.
Treasury's not reacting as strongly, but they are down.
At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year.
Well, I thought that the Fed tool that I don't know if when you come into the Fed tool, I've never been able to sort out, but I don't think that the number that you get right here is live.
Monetary restraint to be realized. especially on inflation.
You say 10 minutes delayed.
In addition, the economy is likely to face further headwinds from tighter credit conditions.
I fail to see how it matters.
Already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate,
It doesn't be okay, but why are you pointing it out?
the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments.
No. I pulled it up because you said the market is predicting a rate cut starting in July, and I said that is inaccurate.
Inflation. And we are prepared to do more.
You don't like the Fed Watch tool. I'm sorry if you don't like the most widely agreed upon and used indicator of that sort of a thing.
Expectations well.
I don't know what to tell you.
Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions.
I think that the Fed tool is an accurate assessment of what the market thinks the probabilities are.
And stable prices.
And and even if you're to look at the difference between them, okay? Sorry. If I went back and I created the SOFR version of that tool, it still wouldn't have a rate cut at above 50%. So you're still wrong, actually.
Stability goals. Thank you. I look forward to your questions.
The difference between them is not that much.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee...
Do you have a tool that shows the probabilities based on the SOFR?
I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So,
okay, show me.
today our decision was to raise the federal funds rate by 25
I'm
basis
deeply
points.
skeptical that this one is going to say 22% and this one's going to say 50%.
That, in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be
Come on, give me the link to pull it up.
the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really
Okay, but
the
how
economy will continue.
how do I translate that symbol into a percentage?
So different people in the committee have different forecasts.
I don't actually think I can pull those ones up.
Path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives.
It doesn't even show up on that one.
So broadly,
I don't think I get that data in action.
Recession, and by that I would characterize as one in which the rise in unemployment is small.
Man, the S&P 500 is all over the place. They were pushing down really, really hard, and now they're pushing up really, really hard. The treasuries have just kind of continued to trade this kind of
We'll leave that to the
slope,
but broadly similar to that.
mostly just like the range between 27 and 30 now.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions.
I could probably pull it up on TradingView.
The account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them.
So you're saying
I would just say this. It's essential
SR3
so that the U.S. government can pay all of its bills when they're due.
June and September?
That would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy.
Let's just do the front month.
Highly uncertain and could be quite.
No, it doesn't show me on here.
I'll just leave it there.
Only gives me daily data
To either side
in here.
We just
Only gives me the closing price. In fact, that's
that
it.
it's very important that this be done. And
Okay, but it says the closing price is 95.0725.
protect the economy.
Okay, but how does that translate to 50%?
Of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that will.
Then the other month that I put on here has the same price, so that doesn't help either.
In today's monetary policy decision, yeah.
Okay.
Oh, thank you. Yeah, Mike.
I really don't think you have a point, right?
Steve Leachman.
So the thing was,
Can you tell us
show what the percentage is.
what the board did in the wake of that February presentation where you were informed that
How do we convert the price to the probability?
banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it.
Well, how do you convert the EZQ price into the probability? I don't.
Briefing of the whole board, the entire board.
Let the CME FedWatch tool do it.
And it was about interest rate risk in the banks.
I could read the methodology behind it. I don't think it's a simple thing from last time I looked at it.
The amount of losses mark-to-market losses they had in their portfolio.
Yeah, you're right. There's a
I
formula.
recall anyway about.
I'm just saying I don't think it's a simple one. Let me come in here.
It was.
Hold on.
I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunities.
Probabilities of possible federal funds target rates are based on federal funds futures contract prices, assuming that rate hikes/cuts are uniformly sized in increments of 25 basis points, and that the effective Fed funds rate will react proportionately to the size of the hike/cut.
Ultimately, it has.
So you would have to take the price, and then you would have to figure out what the implied interest rate is by that, and you'd have to do that for all of the different contracts, and then compare that to the federal funds rate that we're talking about to see which ones of those are above it or below it, right?
Employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean.
Okay, so by the way, I forgot about, we restarted everything. The dollar recovered.
They're on the case
So I'm guessing that the treasuries are mostly just
they mentioned
in line with the dollar at the moment.
or supervisory
That's
action in the
interesting.
form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing
I
this.
find it curious. I would have thought either direction that the treasuries would be a little bit more responsive to like what he's saying compared to equities, because the equities is definitely reacting to what he's saying, but when he's saying stuff that seems like the treasuries don't care at all.
Curious whether you think that further consolidation in the banking sector.
So I think that's a really the fact that the treasuries aren't responding in that situation is a pretty major shot to our
agenda to further
trade thesis.
consolidate, banks. There's been consolidation has been a factor in the U.S. banking industry.
We could still get some upside, but it doesn't look like the upside is coming from anything, or if it comes, it may not be from anything Powell says, unless he really says something major.
So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve.
As the dollar recovered, the indices went down.
Regional banks.
I don't think that's really. Oh, hold on. Why did
So I think it's healthy to have a range of different kinds of banks doing different things.
So how can I
think
try
that's
and
a
show
positive
this to you?
Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed
Yeah, I'd
bank.
say they're pretty closely correlated.
So I really
Yeah.
don't have a comment on that process. As you know, there's an exception to the deposit.
I guess the difference is that when you look at here, right?
The FDIC, I
You know,
believe,
you can see the point from before, and you can see how it went back and then it came back, right?
so
The equities was not quite so simple. The equities was like they were here, they spiked really fast,
I think it's probably good policy that we don't want the
down,
largest banks doing
back up.
acquisitions.
It's not.
That is the policy, and but
It's not the
there's
same.
An exception for a failing bank, and
You know what I mean?
I think it's actually a good outcome for the banking system.
Even though the turns are pretty correlated with each other.
Outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately,
The turns equal each other, but
to follow
the
the
like
law,
the
right?
extents on
The law
each
is it goes to
path
the-
or not.
the least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards,
Now it's starting. Now it's it's been in this range. Now it's starting to settle in this range.
it isn't
Like
possible
the
to
amount
predict
of volatility in here is getting less and less and less.
although firms are trying that, and you know, we're trying it, but ultimately we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month?
These microphones that they're using have like a high noise floor that I can hear, and I'm hearing like the aliasing from
Something that we have to factor in as we
audio codec. It's really weird.
Want to find ourselves. So I guess I would say it this way: the assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it, and that's really all we can do. As I say, it does complicate. We have a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot.
By the way, while we're at it, can you believe that on, what was it, Monday, we were at 3.6 at one point?
Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that.
It's like a $300 move in a week.
Decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you
In a
think
week or two, the oil market will also shout recession. I would say that the oil market is already shouting recession.
Need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But
I think I would say most of these things. I feel like the only thing that's not shouting stagflation / recession right now is equities.
That the median participant thought that this was the appropriate level of the ultimate high level of rates.
That was a
we don't know that.
quick
We'll
little
revisit
hop
that
up
at the
there
June
to
meeting.
29.
And that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
a follow-up on credit, but could you give us a sense of what the SLOOS indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to...
I guess we should be careful about how we say that, right? Because the market doesn't necessarily reflect whether there's a recession or not. It's a reflection of the orders that are placed into it. Now, it can be a pretty good rough guide of certain things. Like, for instance, what, the percentage chance of a rate hike will be. You can kind of sort things out like that. But with the understanding that it is still the flows that move the market, right?
Half of last year.
So you could have a flow that comes in the market that has nothing to do with that and pushes it the wrong way, and then later on it comes back. That sort of thing. But oil came back really hard the past few days, and seems to me like there's selling coming in because there are concerns about the global economy.
Discuss the Fed staff projected a recession.
The treasuries, interest rates on the treasuries are getting awfully low.
Raise interest rates today.
I'm not sure if that's a reflection of that they think that there's a recession. I mean, it could be, but there's a lot of other things going in there that we couldn't sort that out, right?
The effects of those moves.
I think that the treasuries yesterday were reacting largely to the regional banking crisis. So it is possible that the regional banking crisis could continue to be a thing, and yet it not actually move us into a recession, for instance.
A policy stance that's sufficiently restrictive to bring inflation.
It could cause the Federal Reserve to be a little bit easier and make the hard landing easier in some scenarios, right?
I think it's enabled us to see more data, and it will continue to.
Yeah, I don't think this trade makes sense anymore. I'm just kind of hanging on for the kicks and giggles now.
So we always have to balance.
But I probably should have taken it off around 28.5.
Getting inflation under control against the risk of
because
maybe slowing down.
I think the press conference is going about what I thought it might.
Along with the meaningful change in
the treasuries just seem very unresponsive to it.
And just to follow up,
could see something at the end of the press conference. We often see flows that come in after the press conference.
To determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but One way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy.
Do you think that will go down? I think it's still unsure.
Interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the
kind of depends on if we have a recession in the third quarter of this year or not, right?
ongoing.
I mean, the whole thing is that everybody was saying that there was going to be a recession the first half of this year, and we just like pushed it out 6 months or something.
Thank you very much, Chair Powell.
I don't think that the data that we have in the analysis that I have is very good at predicting something that far out.
Of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
You know what? It's let me just say that's not
okay.
What
this is
we're looking
odd.
for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately,
so
we're not looking to get
while he is saying we're not going to change the target,
a goal of getting
him
2%.
kind of having to have the back and forth and being careful about his words here kind of suggests to me that changing the target rate is more likely than he's admitting.
With balance,
I think they will both matter equally at that point. Right now, you have a labor market that's still.
If he was fired now, what do you mean? What do I think? If he was fired today, I think the market would react very poorly.
Employed person, we do see.
I think that the market would react very poorly to any Federal Reserve president being, removed from office prematurely.
We'll have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
I have to say, I haven't seen a move like this in the Treasuries after the FOMC for a while. This is very much not the way that it moved the last 3 or 4 Fed meetings, is it?
Projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate.
I'm not sure if that guy's here is really working for him.
Be avoided, given that
I'd like to see him with a different haircut.
Possibly also
just to compare.
Forecasts as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what
he's transitioning,
because you don't know what they were thinking for first quarter GDP.
No, I don't like his hair.
Thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different, and the reason is there's just so much.
I don't know what you're talking about, Lucas.
It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%.
What's going on here? Oh, we're coming into the options bit close. That's what's going on here.
We see by surveys and much evidence that conditions are
not that much volume for
it really is different. It wasn't supposed to be possible for
the pit close. Pit close, there's usually more volume and craziness than that.
Well, that's what we've seen. So there are no promises in this, but
Lily in the FinTwit space, I'm not sure who that is.
Without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet. Wages have been moving down. Wage increases have been moving down, and that's a good sign. down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not
Okay.
the case of having a recession. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
I think they will be very disappointed by the bank's willingness to lend money in the future.
Of levels that would be consistent with 2% inflation.
It kind of seems to me like banks aren't lending, but I don't know. It's really hard to sort some of the data out, right?
Sure. So
I look out there and it's like, oh, the banks aren't putting any money out there and everything. But then there was a lot of data that we got even today that was kind of like, oh, things are actually going okay for like everybody except for tech.
And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of.
I tell you what, he is such a wonk. Talking about like listing out all those different indicators and how he uses and looks at them and judges them and stuff. That is not talk that I recall ever hearing from other Fed presidents.
A degree of salt, but I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that. That wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices?
I'm wondering here.
So would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand.
When I look at ZB,
not enough supply. And we've been in a situation in many parts of the economy where
I don't see this in the treasuries, but in ZB,
or not flexible enough. And so, the way the market clears is through higher prices. So to get
is like they've been selling it all day.
Goods pipelines.
And the Federal Reserve meeting was like just a temporary blip, and then they kept selling it.
We don't have the long waits and the shortages and that kind of thing. I think you will see inflation come down, and you'll see.
It's not the same in the 5 years.
Result of a return of full competition where there's enough.
Well, maybe you could make the argument.
Then you're really back to full competition.
Didn't really start selling until here, and even then there's like this big jump up and stuff.
Michael McKee from Bloomberg Radio and Television.
That could be part of a spread trade, though. It could be that they're doing a steepener. They're buying the 5 and the 10, and they're selling the 30. Or maybe we could see 2. We might see something about that.
Incoming data, which is
I don't know.
backward looking. Are you going to be
Kind of curious, though. I'm not quite sure what would be driving
ruling out
selling over that period.
I didn't catch the last part. Rolling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And
that's not looking good.
Begin to assess
Well, I think that's time for me to just uke it.
That'll be an important thing. I just, we'll be looking at everything. It's, again, I would just point
I have to say, like, even though when I started taking that trade, I was mostly just like, well, I think it's going to be buy, taking it from there. I don't know if this is really a very good trade, but it's just like there's some volatility. I can work it out.
Due to what's happening.
I made a mistake early on. Otherwise, I probably could have continued to average down. But the flow is just really not what I anticipate.
That in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's
a very different flow than I was expecting.
Yeah. So we on the committee
tomorrow on Friday they met. Well, Friday you got non-farms. That's probably going to be a zoo.
It's going to come down.
Because here again we come into like this number that nobody can seem to predict, and everybody's kind of unsure if the number is even accurate or what it's telling us. Yeah,
it's
going to be an interesting one on Friday, isn't it?
And, quite rapid reductions in inflation. We'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down, particularly now if you look at non-housing services. It really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there.
Really, when you're making comments, you've got to put some reference to what you're commenting about, Lucas.
Courtney Brown from Axios. I'm curious how you view the role.
We'll take a really gambly, risky
do you think
sim trade on Friday too? How about that?
For money market funds to compete with banks for deposits, and did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So
that's a good question.
We looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and
26. That number seems awfully familiar, doesn't it?
Home loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event.
Look at the dollar's higher now than before the news. Just think of that. No, because by the time you say something, I've probably said like 3 things and I don't know which one you're actually responding to. And I probably don't even remember the last thing that I said anyways.
To exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight.
It definitely, I think the last thing that I was talking about was that I think that the non-farms payroll is going to be pretty crazy.
Release would be necessary.
I think that's what I said.
I didn't take part in creating.
And I was thinking, I think so, yes, is kind of a weird response to that comment. But
I find it.
I think that's what he was responding to. That's what was going through my head.
A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that
you know what, I should reset this
into the financial system. I think the only thing that I'm really focused on is.
I think that last little move right there might be somebody. Oh my gosh. Why am I yawning? I'm sorry. That last little move down there was a little bit more dramatic than some of the other movement that we had. I wonder if there was some a bit of a stop run there.
All that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them.
Just because you're so mentally prepared for me to disagree? No, I don't.
I am accountable for doing everything I can to make sure that that happens.
You know what the funny thing is that when you guys say those things, I don't necessarily feel like you're disagreeing with me.
Thank you. Evan Reiser with M&I Market.
I think that most of the time you're saying like you're trying to
of the banking turmoil among regional banks.
You're trying to be even more nuanced and more accurate,
rates,
per se.
Is that what the statement is saying?
So
I don't trade options very often, Magic Castle. I've taken them on occasion. I took an options trade in oil last year that basically made me profitable.
Large banks.
When I did the taxes and I looked at it all after the fact, I was like, oh, actually that one trade is what took me over the
period of stress
over the break-even point.
And all the
but usually I don't take them. I'm only going to come into options when I really found something that the rest of the market is missing. You know,
is an important step toward drawing a line under that period of severe.
Sometimes it's definitions.
I also think we are very focused on what's.
I don't think that was the case with the argument I was having with Akshay earlier, though.
In the beige book, and you will see in the sluice, is small and medium-sized, small and.
I mean, my understanding is that for quite some time, the curve has kind of been suggesting that at some point there will be like rate decreases, but I think it's a little bit further out than that.
What's going on?
And it's certainly
factor that assessment.
There could be other alternative explanations for that curve.
Okay, Greg.
Now that's really interesting you say that, Magic Castle. I gave up on futures after sim trading for a year. I find the options game is less risk. I do not see it that way at all, because in options, I basically like to do anything worthwhile, I have to be risking at least $100 or something like that, right? And I can come over here in futures and can literally just risk $10.
Yep. Comments on
that?
You know?
Sure. So let me say, first of all,
I don't know if I would say smarter.
Plus years now, and I fully recognize
the options game is very different.
Learn some new
right?
things as well. And
it's a very different game.
I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those.
I mean, you can come in and speculate with options, but
I can to foster.
I don't think that's what the people that are making most of the money with them are actually doing.
Vice Chair for supervision,
I think that the guys that are really making money with that are a little bit more sophisticated than that. A little bit more quantitative than that.
It says, shall develop policy recommendations for the board regarding supervision and regulation of depository institutions.
My volatility trading feed on Twitter sure does sound smart.
Of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair.
I think part of that comes down to that I really feel like that a lot of
Congress wanted that person to have political
the
accountability.
advantages and what futures trading actually ends up being is a little bit misunderstood by the community.
A good working relationship.
I think that the community thinks that
privately
and futures trading is where you should go if you really want to do technical trading, I want to actively trade one instrument and just get really technical with it, and
including working with
that's kind of why I got into futures in the beginning, but I don't really think that that's the case.
And that's appropriate. I believe that's what the law requires. And,
I think that if you really want to trade a quote pattern, you're probably better. First of all, I don't think that that works very well, but if you were going to do that, you're probably better off in stocks, because then you can use a scanner and you can find the stock that's doing the pattern and is really, you can kind of add in a couple of like fundamental indications in there and stuff.
Supervision has sole authority over supervision.
Yeah, so probably they should be more math knowledgeable, that's for sure, for the options, especially on the statistics side.
That, decisions that maybe
this is where it comes down to is I think as a vehicle for speculation, that's where futures are really powerful, I think.
Sure. I mean,
something, you want to trade it fast and you're getting, in and out.
You don't get to do that. Again, focus is on
the patterns, man, like especially the treasuries. Treasuries are so effing efficient. It's really hard to get anything out of patterns from treasuries like that.
Fair assessment, learn the right
price patterns at least.
Figure out what the fixes are and implement them. And I think Vice Chair Barr's report is an excellent first step.
You have a limited number of instruments, so you kind of just have to pick your one instrument, and then a lot of the time it's just not doing what you want.
Hi there,
right?
Sala with Barron's.
Average retail trader knows shit about stats.
At this meeting come up at all, and how
It
seriously
sure seems like that to me.
considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again.
It sure seems to me like I have a difficult time getting retail traders to understand the consequences of fat tails, right?
I would say there are a number of people, and
man,
see this in the minutes. I don't want to try to do the head count.
So there was like that kind of what I was saying was maybe a stop run. They just like completely turned around since then. In fact, you get 15 ticks slower.
At the beginning, that as I mentioned, if you add up all the tightening that's going on through various channels,
and the 5 years is hitting back quite hard, and the cumulative delta in the 5 year is much stronger over there as well. So some indications that this whole thing has been some sort of slow motion spread trade,
How to interpret that?
where they sell the 30-year first and then they buy the 5.
Higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
Ooh.
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly.
I sure would have been happy to have heard him actually answer that question, but that's expecting too much.
Make a careful assessment.
And we'll go to Nancy for the last question.
I appreciate you asking that, reporter lady.
You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history.
They totally just waited for me to dump it before they went, right? If I had held on to it, they wouldn't be coming back up.
In regulation and in supervision. We know
it's all me.
It's possible.
It's all me.
I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think
is my heater on or something? It's really hot in here. Hold on a second.
I guess I would just say that. Then we're gonna revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
I don't know. I don't know why it's so hot. Oh, I gotta stop that. Stop. Great. Now YouTube is going to be like, Seth, you are using copyrighted music that the Federal Reserve has. You can't do that. Flash crash? Well, I tell you what, equities don't look so hot. I don't know. This at the moment, I think we can stick around until 2, right? I listen to the Federal music in the gym. Sure you do. Okay. No, I don't know why I thought that was so funny. I cannot imagine pumping iron to that. No way. Okay. Anyways, it kind of feels to me like the Treasury's doing its own thing and the equities are doing its own thing. I mean, they are pivoting with the dollar. Don't get me wrong. Like we are seeing major shifts in the dollar, and that's when these things are coming. But like, they don't all seem to match up. Or more broadly, you know, like at the moment, well, listen, when the treasuries were coming down, there was these points where the equities were going up, right? But now we have the treasuries coming up like really hard and the equities are falling really hard. That I'm wondering if that's something else. Like, are we getting like more banking crisis nonsense? Let's pull that up real quick. Or let's pull it up over here. Oh, no, we'll close that one. Okay. It's too much full. I don't know why you'd want NQ in the first place. That thing just kills accounts, man. I'm telling you. Oh my gosh. What is the name of this stupid KRE? There we go. Dude, it is totally KRE. Since 1240. And I say 1320. 1310. Totally still it looks like it is them. Why did you laugh the other day when I asked you which coding editor you use? Oh, I forget that you're a little bit more new to the coding. So like, which coding editor you use has kind of been like a war for a really long time. And then there was a period where it kind of was like, depended on what you were doing and stuff. And then it turned into everybody just uses Visual Studio Code. Right? It was really kind of a weird thing. Like what happened was Visual Studio Code was really geared more towards the guys that are doing like web development, I would say. Because if you're doing like C++, C# or whatever, you do it in Visual Studio. You do it in a fully fledged IDE, right? And the code editor was more for like script stuff like JavaScript or Python, right? But then what happened was Visual Studio Code became so popular so quickly that even a lot of the coders now are using Visual Studio Code straight up, right? So that's why it was funny to me, right? And I spend a lot of time like looking at alternative editors, right? So like what is it, Ruby text, or not Ruby, Rust text editor. What was the name of the one that I liked? Oh, it was Helix. Helix is pretty good. I have it on my machine here, actually. I think I have it on here. Hold on. Let me find it. Yeah, here it is. See, here's my text editor. So like the way that the text editors that I use work is like if I type stuff right now, I'm typing stuff. See how it's doing stuff down at the bottom? So sorry, at the bottom. It's because it's a modal text editor. So in order for me to actually write text, I have to go into insert mode. So I press I, and it changes to insert mode, and now I can type. And I have to hit escape again. Does it do? Oh yeah, it does. It does most of the Vim. I was concerned that I wouldn't know enough of the keybinds to be able to do stuff, but so like I can move up and down and right and left using HJKL, right? So I can do everything that I need to do editing without ever having to take my fingers off of the home row keys. Not having to take my fingers off of the keyboard, rather, right? So these are kind of like advanced text editors, right? But like if you're new, you might not want to get into this because like learning how to use Vim is like a, you know, that's one of those things where you sit and you practice it every day for like 30 minutes or something, go through like these Vim tutorials and challenges and stuff like that, and learn and build up the muscle memory for doing the text editor. And if you do that, then you'll get really fast at editing text. But it's like a super esoteric thing. That's why it's kind of like, you know, because what I want to tell you is, oh dude, use Helix. This is so cool. Like all of these new tools made in Rust, they're so cool. Try Helix. But that's not, if you're just starting out, you don't want to use Helix. No, that's a dumb idea. It's a terrible idea, right? But Visual Studio Code, oh yeah. Especially if you're going to be using, it was Python, right? The thing that you were looking at was Python? I think it was Python. I don't remember anymore. If you're doing like C#, C++, then I would just use Visual Studio, like Visual Studio, because then you have like an actual IDE, right? I think that an actual IDE is a real advantage. But like if you're doing Python, you do everything through the command line in Python anyways, it doesn't matter. You can use Visual Studio Code. Okay, so you know what? It kind of, this, like I'm thinking back on it now, I'm a little pissed because this is right where I had my orders and everything. So it really did just squeeze and squeeze and squeeze until it gave up on it and then bumped back up for no apparent reason. Well, no, it wasn't for no apparent reason. It's because, well, I think that this regional banking ETF is doing something. I do think that's a factor. But, and it looks like things are kind of moving a little bit with the dollar. But this really looks like risk off flows. I am kind of wondering if these risk off flows have anything to do with the Fed meeting at all.
So looking now to the early market on close imbalance, currently sitting at 180 million to the sell side.
You like pie charm? Ah, yeah. Yes. I think that's like a Python specific one that'll do well for you. YouTube put emojis to spam on screen by tapping. TikTok wannabe. No, those have been there for a long time, Oceanic. Haven't you ever? Oh, you have to be a subscriber. If you're a subscriber, then you can do things like this. And you can use the rainbow bear. You can use the rainbow bear emoji. We really should make better use of the emojis, I think. I would like the stream at some point to be more in line with the not more in line, but to utilize the emojis more. And like, I want to make a sentiment robot that would take your guys' input from the emojis into consideration for what it does. I think that'd be kind of fun. Right. So if everybody on the channel starts posting rainbow bears, then it will be like, oh, I better go short. Wouldn't that be cool? It would be a terrible algorithm, but hey. And maybe we could put like some machine learning attachment to it, and maybe it might start doing the opposite of what you guys say. But once it figures out that you're messing with it, who knows? What do you guys think? What do you think is driving this buying that's kind of popped up out of nowhere? Do you think that it's just kind of like counterflows that happen from the Federal Reserve meeting and that sort of stuff that can be kind of, you know, what is it called? Is it endogenous? Is it endogenous flows just that emerge out of the market itself because it's a Fed day? Or are these risk off flows coming in because of more regional banking fears? Did he say something in there that I missed that was important? Because I'm like the worst at paying attention in these things. Like if I was a reporter in that meeting, it'd be so terrible. I'd be like whispering to my colleagues the whole time. Everybody would be like, Seth, shut up. Yeah, it wouldn't be good for me. FTC says Facebook repeatedly violated its privacy promises, puts young users at risk. What's this? The top story on Zero Hedge today that was from far before this, and it was taken from Michael Snyder via the Economic Collapse blog. Well, that makes me instantly skeptical of what they have to say. The name like that. They're now saying that the bank asset size for bank failures is now higher than it was in 2008. And that it's not over. I can buy that. Sure. Meta, the parent company of the Facebook platform, has failed to comply with Federal Trade Commission's 2020 privacy order that bars the social media company from profiting off data it collects from young users. Shares of Meta slid as much as 2% on the news. Then I close my freaking chart. I'm so dumb. Hold on. Maybe Meta, maybe it lines up with Meta. Let's see. Meta. No, that was earlier today, much earlier today. If that happened, actually, I'm curious. What did the equities react at that time? index react at that time? It did not. Did not. Yo, you can hear. Did you hear my teams pop up? Yeah. I am not. Does anybody actually like Teams? I mean, I don't feel like that if Microsoft was listening, that I'd be telling them anything that they don't already know. But Microsoft, Teams sucks. Everybody hates it. You really should adjust it. Here's what I would like to see with Teams. Number one, I would like to see more customizability in terms of how messages are displayed, because I can pull it up and I can only see 1 or 2 messages, and I just can't see very much history. So it doesn't work very good as a chat application. The other thing that I really hate about Teams is the notifications. The notifications are terrible. If I could set it up the way that I want, then when I'm available, every notification that pops up there at the bottom would stay there, because I just ignore them and forget about them. It's trash. It is. It's funny because it should be such a simple application, but it ends up being something that's actually quite difficult to do well. Well, the Treasury's coming back quite a bit there, but still not much of an indication about what's going on. We did steepen, so I guess the post Federal Reserve steepen yield curve trade is a top contender for what's going on here too. I think we could put SVB Bank, regional banking failures in there as well. Bring KRE back up here. KRE. And the little bit of a turn here that we're seeing in Treasuries does coincide with a little bit of the turn that we're seeing here in KRE. If anything's screaming recession, it's their Treasuries when these risk offloads come in and there's fears about regional banking. And it seems to come out of nowhere every time, right? Every time that it's happened, we're like, what's going on? Why is it doing this? Not expecting it at all. It's kind of odd thing to me. It's like the conspiracy theory in me is coming out now. The conspiracy theorist is coming out in me now. It's like, oh, the Federal Reserve didn't get significantly more dovish because of all of the volatility that we've had in the regional banking sector yet. So that means that we have to keep pushing it even harder so that Powell learns next time. Minimize. And that's about all we've got to go on here. I guess we can stick around 20 more minutes to see the close, but oh, look at those treasuries come right back. I mean, I think that kind of suggests you want to go long, right?
Early market on close imbalance, still sitting at 180 million to the sell side.
Okay. Just got hurt the market on close imbalance numbers, but it wasn't too big yet, but it was sell side. Can't believe that one at 05 didn't get filled. It's funny. I'm hearing clicking. Oh, that's over in equities. Hey. Thank you. So that means that you can now push it against me and go all the way back to the lows of the day again. Right? That's kind of doing the thing there. Where it's like you think it's going to tick down and it never does. It's like, look, there's only 200 contracts. They're going to hit that one, right? And then it doesn't go. Like, or they do try and hit it and there's an iceberg behind it. Yeah, there you go. Oh, there's the iceberg. Yeah. It'd be like that. I don't know how I can tell that that's what's going on, but as you know, now after the fact, you can definitely see that was correct, right? They are gonna go up there. What is this? Is it time to panic yet, guys? At what point, like, how high do the treasuries need to get on the week before I start to panic? And I'm like, something's wrong. Come on.
Early market on close imbalance still at
Okay,
180 million to the sell side.
This is consolidating higher, man. Wonder how much sense it makes in this market to just kind of always be looking out for that buy. I come back down here. Well, there was the big decline on, what is this, the 27th, and the big decline on the 30th. I don't know. Kind of seems like on the higher time frame that they're a little bit more prone to want to go long, doesn't it? Doesn't it? Meanwhile, dollar's still in a range here. It's getting hot in this room. I think it's time to end the trading day here soon. Oh, don't forget about your question. Okay, so the volume profile. Okay, so the general theory that volume market profile practitioners have is generally wrong, but they're still making a theory based on actual observed market data that was not like a terrible theory. And so with more information, particularly the information that we have in our proven market behaviors video, and especially the stuff about liquidity holes, kind of explains why the market behaves in the way that they think it does. And when you combine that information together, I think that you can make much more accurate assessments of what's going on. But generally speaking, the idea that like a price that traded a ton of volume before, like the point of control, that price will somehow hold some significance or predictive value in the future is really pretty much not true. Okay, but there is this behavior where the market will switch between trending and mean reverting markets that is based largely on the existence of large meta orders and the liquidity holes that kind of will form in random locations. And so you know, I can see those liquidity holes form, and I can identify areas, you know, like there was a lot traded there 08 half, by the way. You know, that's a possible place that could become a point of control, right? What about amount of time traded at a price? It's they're basically the same thing. I mean, they're using the same, the underlying theory that they use, market profile versus volume profile, doesn't change. So, but when I'm talking about this, I'm talking primarily volume. Most of the time, the volume point of control is the same as the market profile point of control. Okay, so it came back at 08 half. 5 years still pushing though, so we got to keep an eye. The 5 years, what's going to guide us?
Currently saying 600 million apparently. To the sell side. Just waiting for the final orders before we call it. The market close meter for the NYSE, 680 million to the sell side.
Okay, so they're telling me the market on close was 680 sell. It's not huge, but a decent sell. Could be enough for us to continue moving down here today. Well, the 5 years pushing. Well, now I'm looking at this and realizing that there was like that 116 area for a while that kind of seemed like the center line. We dipped so far below that down to 24, and now we're pushing so far above that up to 10. That is really quite a dramatic turn. And again, I just don't see what's causing it. I kind of feel like I must have missed something, that he said something towards the end of that press conference that really shifted the market or something. And stuff. That's a weird. Where'd you get that emoji from? Oh, those are the YouTube emojis. Gotcha. YouTube emojis are dumb though. I think that they look. I'm not a huge fan of the art style of them. I remember the original forum that, well, not the original forum, but the first forum that I posted on. And they had this one emoji. My favorite one was they had this emoji that would do the roll's eyes. That was such a good emoji. And I think that the emojis that they had there on that board look way better than any of the emojis I've ever seen come since then. And they also had a nice one that would like shoot a Redeemer missile out and then it would fly around and come back and hit him and explode, and huge nuclear blast. It was super cool. Oh, those were the days, boys. Still got 8 minutes. So, if I had traded this, I could have made $50. At what point would I have traded it though? 02. I guess I could have made money on this. Actually, you know, well, so I really, one of the things that I said to myself when I came in here was like, Seth, you really better have a really, really good reason to take a live trade if you take a live trade in this, because one, I have screwed myself over really bad on FOMC day in the past, right? And the other thing is that the medication that I'm on wears off by noon, and so I am likely to be more impulsive and things like that. And I found that when I'm trading off of my medication, that has really been bad for me as well. So I don't know if there's anything that could have happened that would have gotten me to have taken a live trade from it, but I probably could have gotten away with it, because at that point, you know, the volatility had really calmed down and there was a really strong move to the upside. I don't know what caused it, and so of course there's no way for me to have known that it, after kind of consolidate, you know, doing a little bit of this, and then it would just like soar higher like it has. This is really an astounding move, isn't it? Okay, so I'm seeing some big orders clicking around in S&P 500. May have found some agreement here. We'll see. Oh, they got slammed right there. Look at that. So when I see the Treasury go like 3 ticks at a time, I'm definitely like, okay. There's some aggressive buyers out there, right? If I don't understand why it's going on, then that's like a really good reason to not get in. But here we're like at the highs of the day. It's in line with where my position and everything. It's going. Yeah, I love that. That's really strong trending action. Get out of here. I'm still kind of pissed because if I had done all of this, I would have a better long position from 116 even. Jeez, that's so the way this flow has ended up coming out. I don't know, you know, like in these situations, I don't know if there's really any way for you to predict that one, you know? Somebody decided to start buying at that moment, and we may never know why. Just some freak order flow out of nowhere, man. But I haven't seen a Federal Reserve day with this much drama in the treasuries in a long time. I mean, the whole thing was weird. Like the action immediately after the news, like it just like slowly kind of curving down and flattening out and everybody ignoring it and everything, and it not really reacting to the news conference or any of the you know, S&P would be moving strongly, but the treasuries wouldn't, generally speaking. That's all really, really weird. And then to see it just take off like a rocket like this is just so astounding to me. Okay, there's a big take right there at 11. Looks like you're probably going to see quite a bit of volume to your trade at the close, though. So I'm going to take one there. Oh, come on. There we go. I don't know why I feel this way, but I kind of feel like just letting this, well, okay. I got my cost basis all the way down to 25, so I guess I can't complain too much. I think this one is worth keeping on. So, you know, maybe it will completely retrace overnight, but I would like to see where we're at tomorrow. I do think like longer time frame, you know, that we are likely to move higher. And remember earlier when we were on the upside that I was like, you know, I would like to keep it if it wasn't for all of this other data and stuff that was coming along that I'm concerned would be hawkish, right? I'm not as concerned about non-farms. I mean, non-farms is just going to be crazy no matter what, right? But that might just be a road bump. It still looks to me like the treasuries are just like you know, fixed income is a real investment again, right? So I think it's worth trying to keep something and like really trying to swing it. So all right, well, that's all we got for today, guys. Thanks for sticking with me here, even though I like absolutely sucked, but that's okay. I guess I can be happy with this in the end. It was super interesting anyways, and I didn't lose any money on it, so it's like cool. It's fine. It's fine. I'll see you guys tomorrow morning. In the meantime, stay excellent, team.